In this video, I'm going to discuss internal controls for the payroll cycle. Before the auditor can test the effectiveness of a client's internal controls, the auditor first needs to understand the design of those controls. And the auditor can learn about the design of the controls by performing a walkthrough. The walkthrough involves the auditor going through each step of the client's payroll cycle, starting with the initial hiring of an employee all the way through to the recording of a journal entry. And whenever the auditor notices an area where there could be a potential misstatement, the auditor needs to ask the following question. Has the client designed a control that, if it were operating effectively, would prevent or detect a material misstatement? Now, I'm going to start out by talking about entity level controls, and then I'm going to talk about one of the most important controls, segregation of duties, and then I'm going to give you a long list of different controls that a client could have in their payroll cycle. So let's start with the entity level controls. The auditor should ask, does that audit committee play an active role? For example, if they say, yes, that audit committee meets every single month and they take the financial statements and financial reporting of this company very seriously, that's great. But if you say, well, the audit committee, they meet once a year and they don't really seem to care what about the integrity of the financial reporting of the company, that would be a problem. And we'd say, okay, there's going to be a bad internal control environment for this company. We also want to look and see, are there written policies and procedures related to adding of employees to the payroll system and also removing people who have been fired. Okay, so when someone leaves the company, we want to make sure they were removed from payroll, and when someone's added, that they're added to payroll, but we want to make sure that there is proper authorization. We don't want fictitious employees being added to the payroll, and we don't want some dishonest person to keep people who've been fired on the payroll and not remove them and then collect their checks. Okay, so authorization is very important. Also, in terms of making changes to payroll information, the address of an employee, pay rate of an employee, things like that. Is management closely monitoring payroll liabilities? Does the board, if there's significant amounts of executive compensation or the company has share-based compensation, is that something that the board is actually monitoring? If you have strong entity level controls, then that is going to reduce the risk of material misstatement. If you have very weak entity level controls, then that's going to be a problem because it's going to hurt the control environment. Now, I had mentioned segregation of duties. This is perhaps the most important control when it comes to the payroll cycle. Now here, I've got the 6 different steps of the payroll cycle here again. Now what you don't want is a single employee being in charge of multiple steps. For example, nightmare scenario where you have one employee that is responsible for all 6 of these things. Okay, so let's just say, for example, I got an example here. Let's say you got someone named Sue, and they work for a company. They don't have segregation of duties. So it's Sue's job to add or remove employees from the system. She also approves timesheets to say, oh, okay, this person worked 40 hours or 30 hours. She processes the payroll. She does the journal entry. She does everything. So why would that be a problem if Sue has all those responsibilities and we don't have segregation of duties? Well, let's say Sue added a fake employee named Tom Smith. Okay, there is no Tom Smith at the company. She just says, well, hey, I have the ability to add employees to the payroll system, so I'm going to add Tom Smith, and I'm going to say that he makes $25 an hour. And then, because she's also able to approve timesheets, she's going to say, he worked 40 hours this week, and it's, $25 an hour. And so, okay, he is owed, we've got $1,000 here that he has earned. She's going to go through, process the payroll. Tom Smith is going to get a check. Now, she's going to collect the check for herself, sign it over to herself, and deposit it for herself and basically steal this money, steal money from the company. So segregation of duties prevents that from happening, where if the person who's responsible for adding employees to the system, that they don't also process the payroll, distribute paychecks, record the journal entry, and all these other different things. Okay, so we want different people doing these. Now, this is difficult. Segregation of duties is challenging for a small business. If you have a company with just a handful of employees, it's very difficult for them to do. But ideally, at a situation like that, you have the owner of the company, because it's a small business, actively involved in all those different things. Now, I've got some more examples here of segregation of duties. So I have here different duties that would be segregated. And then here I have in this column talking about what would be the problem if the duties aren't segregated. Now, I'm just going to talk about one of them. I'll talk about this bottom one here. So if we have the person who distributes paychecks, or if they pay with direct deposit, authorizes those transactions. But let's keep it simple. Let's distributing paychecks. Okay, so let's say that Sue, let's go back to this example with Sue. Sue gives out the paychecks. Okay, if she does that, and she's also responsible for hiring or removing terminated employees. So again, if she were to say, okay, well, you know what? Hey, there's this guy Tom, and he works for us now, and then there's a paycheck distributed to Tom. If there was segregation of duties, then someone else, let's say Sally would be distributing the paychecks, not Sue, if there was segregation of duties, right? So Sally would distribute the paycheck and say, hey, wait, there is no Tom here to collect this paycheck, so we have an unclaimed paycheck. Let me look into this and see what's going on. Maybe this is a fictitious employee. But if we don't have our employee handling that, we have Sue both adding people to the payroll, which she does. She adds Tom as a newly hired employee, and then also Sue is the one distributing paychecks. Then Sue would add this fake employee, and when it comes time to pass out the paychecks, she doesn't give one to him because he doesn't even exist. She just pockets the paycheck, and no one notices that there was an unclaimed paycheck. Okay, because Sue was responsible for both adding employees to the system and distributing the paychecks, so she has concealed the fact that there is no Tom, and she just pockets a paycheck, signs it over to herself. Okay, next, we're going to do a more in-depth example here. Okay, I want to give you, I've got actually a really long list of potential internal controls that a company could have. I'm not going to go through every single one of them, but these are all potential internal controls for the payroll cycle, okay, related to payroll transactions. Here we have assertions in this column right here. Okay, it's, as I said, a pretty long list. But as we go down, I have assertions being made by management regarding payroll transactions. For example, management is asserting that they actually occurred. And then here in this column, I have the potential misstatement that could happen. And here are potential internal controls. So for occurrence, I actually have multiple internal controls. I already talked about segregation of duties, so I'm not going to talk about that. But here, we'll talk about a changes report. Here's what a changes report is. If the company had, and this is a very important internal control, the company should have it set up whenever changes are made to someone's employment status, their address, something like that, then that goes to multiple, there'll be someone in the organization that is going to see that changes report. Okay, so for example, let's go back to this person, Sue. All right, so Sue goes and she, let's say, just got a fictitious employee or something, whatever, and or actually, you know what? Let's say somebody got fired. Okay, somebody named Billy worked at the company, and Billy got fired. Billy's no longer with us. I mean, well, he's not dead, but he's fired. And so Sue goes in and changes Billy's address, okay, in the system to her address. So then Billy's checks come to Sue because, you know, let's say Billy's not removed from the system, so she goes in and changes the address. But if Sue's boss or somebody else were to get a changes report that says, hey, there's this employee named Billy and his address got changed, and then they look it up and they say, hey, wait, that's Sue's address. They could say, hey, what the heck is going on here? I think we've got a fraud. Okay, so that's what I'm talking about here with a changes report. Also, timesheets. If the company uses time cards or timesheets to say, oh, okay, this employee worked 45 hours and somebody assigned that, it should be approved by the supervisors of those operating departments. So the people actually know if the employees are working. So if for example, there was an employee named Rick and he submitted a time card to say he worked 45 hours, his supervisors should have to sign that. Okay, so there's someone over him to verify that he, in fact, did that work. Now, mailing earnings statements to the home address of employees, that's helpful. So in the United States, the earnings statement, we have a thing called a W-2. If you're in a different country, I don't know what your earnings statement is called, but you likely have something like this. So this gets mailed to the employee's home address. So then that employee, so let's say the scenario with Billy. So Billy was fired, but let's say Sue had kept Billy on the payroll and then was collecting checks. If Billy then gets a W-2 at the end of the year and says, hey, you earned all this income, and Billy's going to be like, wait a minute, I was fired. I didn't earn all that income. Why am I getting a W-2 here? And he's going to complain, so he's not going to want to be taxed on that. So those are some internal controls, again, related to occurrence. And the issue with occurrence, again, we had a number of potential problems, fictitious employees being out of the payroll, people who've been fired, being kept on the payroll, people who are actual employees being paid for time they didn't work, and so forth. Now, I want to talk about the assertion of completeness here. Now, as I said, completeness is not as big an issue with the payroll cycle because in terms of an employee is going to complain if they don't get paid. But when it comes to disclosures, completeness is very important, and you're going to want to do a disclosure checklist. So the auditor is going to want to do that, but the company itself should also have some way of verifying that they have made disclosures appropriate for executive and or share-based compensation. For example, in some countries, some types of companies that they have to have, if the executive compensation, they have to have like the ratio of the CEO's pay to the pay of an average employee. And if we're talking about share-based compensation, thinking about, well, what pricing model was used to determine the fair value of the share-based compensation, when were the stock options granted, things like that. Okay, so there should be some way of verifying that the disclosures have actually been made. In terms of authorization, this is very important because who has authority to add people to payroll? Who is responsible for removing them from the payroll system? Who has authority for approving timesheets? And are timesheets even required to be approved? If someone just comes and submits a timesheet and says, hey, I'm Rick, and I work 40 hours, and there's no signature there from somebody else verifying, right? There should be something that says, hey, Mike, Rick's supervisor, verified that Rick, in fact, work those hours. If there's no signature at all, then we got a problem. All right. So in terms of internal controls, we shouldn't be paying Rick unless we have an approved timesheet. Okay. We have Rick submitted a timesheet and that it's been signed by his supervisor saying, yes, in fact, he did that work. Otherwise, we might end up paying somebody for time that they didn't do any work. So again, we always want to make sure there's proper authorization. We want to pay actual employees for actual time worked at the appropriate pay rates. Now, when it comes to accuracy, we're talking about calculating gross pay and net pay correctly. We want to make sure that we do that. Remember, gross pay is the employee's pay before any payroll deductions. Net pay is after the payroll deductions. How can we verify that we are calculating this correctly? Well, you could compare the company's actual payroll costs. So look at their actual labor costs, and then compare that to either budgeted figures or if the company does standard costing, the standard cost of what the labor is. If the company isn't hiring tons of people or if they didn't do a bunch of layoffs, then the payroll tend to be fairly stable from one period. So if you see it like this and then all of a sudden spikes up, you might say, hey, what happened here? What happened? Why did all of a sudden the payroll is a lot higher than what we had budgeted or what the standard cost, what the labor costs were expected to be? If they had just hired a ton of people, okay, that's understandable perhaps, but you always want to look and say, okay, wait a minute, compared to what we expected, why was there a big gap between what the actual labor is and what we thought it was going to be? If there's a big gap, could be that there was some kind of fraud involved. You just want to look and make sure. Now, in terms of the cutoff assertion, we're wanting to make sure that payroll transactions were recorded in the correct period. So things we can do, these timesheets, right, when it says, okay, Rick worked 40 hours, whatever, they need to promptly forward those to the payroll department to make sure people get paid. So just obviously the employees want to get paid on time, but also that the company will end up recording this in the appropriate period. And in terms of the classification assertion, we want to make sure that the payroll costs are being coded to the correct accounts. Okay, there's lots of different types of compensation. We pay employees for services, but is it sales commission? Okay, is that what the expense is? Are we talking about general and administrative expense, like the salary of the CEO? Are we talking about, if it's a manufacturer, is this direct labor or indirect labor? And so if it's direct labor for a manufacturer, that's going to be a product cost. And that's going to go to inventory. And then when the inventory is sold, it's going to go to cost of goods sold. So thinking about how these payroll transactions are classified and whether they're coded to the correct accounts could affect inventory or COGS for a manufacturer. So what are we going to do? Well, we want to make sure that the company's closely looking at the chart of accounts and appropriately classifying the payroll transactions. If you say, well, actually, we looked at the internal controls related to classification assertion, and we see that this company doesn't even have a chart of accounts, and we talked to the accountant who codes these transactions, and they said they just wing it. Okay, that's a problem, right? That's a problem. Then we understand, okay, they don't really have any internal controls related to making sure that payroll transactions are classified correctly. So now, once we have gone through and understood exactly how the client's internal controls are set up relative to the payroll cycle, the next step is we're going to look at the operating effectiveness of these controls. So it's one thing to have a control designed, it's another thing for the control to actually be working. And we will talk about that in the next video.